There is a machine, hidden in plain sight, that consumes dreams. We see its bright, shining products and hear stories of rare successes, but the machine itself, and the fuel it runs on, remains largely invisible. This is the world of startups, a landscape of immense promise and almost certain failure. The story we're sold is one of merit, where the best ideas rise to the top. In reality, a powerful current pulls nearly everything down into the deep. This current is made of incentives, expectations, and a very specific kind of money. It shapes the behavior of thousands every year, guiding most to a quiet end. Their companies disappear, their ambitions shelved, not by accident, but by design. The system is built for a purpose that has little to do with building stable, lasting businesses. We celebrate the rare survivor, ignoring the 99 who vanish. The real story lies beneath, in the silent machinery that dictates who is allowed to succeed. Until we understand how it works, we'll keep watching brilliant dreams extinguished, one by one. We love the myth of the lone genius, the garage inventor who changes the world. It's a story that makes success seem accessible to anyone with a clever idea, but this myth ignores the environment, the resources, and the networks that make ideas possible. Behind every overnight success is a structure of privilege, connections, and funding. The system wants us to believe the idea is everything, distracting us from the truth. Execution and resources matter far more. Venture capital isn't hunting for the best ideas, but for those that can scale at breakneck speed. This focus redefines what a good idea even means. The myth also burdens founders with impossible expectations: visionary, strategist, leader. When ventures fail, blame falls on the individual, not the system. This isolates failure, protecting the system from scrutiny. The myth is not just a story, it's a vital part of the machine. It keeps the flow of new dreamers and their ideas coming. The system didn't appear overnight. After World War II, a new kind of investor emerged, funding risky ventures and radical technologies. This was the birth of venture capital, a departure from traditional banking. Early VCs knew most investments would fail, but one big win would cover all losses. The model wasn't about building sustainable businesses, but finding outliers with exponential growth. Steady, profitable companies were failures in this model. They didn't deliver the explosive returns funds needed. Money flowed to founders who promised massive, rapid scaling. The goal shifted, not to build a good company, but to dominate a global market in under a decade. This created intense pressure for growth above all else. The patient work of building a business was replaced by a frantic race for market share. The system selected for speed, not resilience or profitability. The hunt for the outlier had begun. And with it, the staggering failure rates we see today. As venture capital matured, it developed its own logic and culture. Funds needed to promise extraordinary returns to attract big investors. This pressure trickled down. Portfolio companies had to aim for massive outcomes. Founders who took VC money agreed to a timeline and expectations. Grow fast, spend aggressively, expand quickly. Go big or go home became the mantra. If a company couldn't achieve exponential growth, it was better for the fund if it failed quickly. A healthy, profitable $10 million business to a billion-dollar fund, that's a failure. The path to smaller, sustainable victories was closed off. Startups burned through cash, not out of irresponsibility, but by following the playbook. The race was to capture the market, not to be profitable. For every winner, many ran out of money along the way. The strategy allowed only two outcomes: world domination or complete failure. The system demanded it. The system isn't a garden for nurturing businesses. It's a filter. Its purpose is to test, not nurture, applying extreme pressure to find the rare unicorn. Most startups are simply material for this filtering process. Their failure is a feature, not a bug. It starts with the pitch. Founders must promise exponential growth and billion-dollar markets. Grand ambition is rewarded, not pragmatic goals. Once funded, the pressure intensifies. Growth metrics matter more than profit. Each investment round demands even faster growth. The company isn't climbing a hill, it's launching from one rocket stage to the next. Failure to ignite the next stage means falling back to Earth. The system is designed to burn through 99 to find one. It's a model of immense waste, justified by the value of the outlier. The system doesn't ask how to build a good company, but how to find $1 billion one, at any cost. It works perfectly, just not for the reasons most people think. The filter has layers, story, growth, and finally, the market itself. A startup can have a great story and growth, but without a real business model, it fails. Venture capital provides a temporary lifeline, but it's not infinite. When the money runs out, the company must stand on its own. Many well-funded startups collapse at this stage. Think Webvan or Pets.com. They scaled fast, but their economics were broken. VC money only delayed the inevitable. The system encourages scaling before validating the business model, a huge gamble. Sometimes it pays off, as with Amazon, but for every Amazon, there are countless failures. The system doesn't help companies find profitability, it lets them run faster in the wrong direction. The filter selects for ambition, speed, and finally, sustainability, but most never reach that last test. The pressure for speed means many never build a solid foundation. The system is a stress test, designed to find breaking points. For most startups, that breaking point comes before profitability. The filter has done its job. Who benefits? Primarily, venture capital funds and their investors. A single big win pays for all the failures. This is success for the fund. The 1% of founders who succeed become wealthy and celebrated. Lawyers, bankers, and a whole industry profit from the cycle. For them, the system works perfectly. But who pays? Founders and employees of failed startups. They invest years, passion, and savings for stock options that end up worthless. The emotional toll is immense. Burnout, depression, and a sense of personal failure. Society pays too. The focus on winner-take-all markets means countless other problems are ignored. Local, niche, or community businesses are starved of innovation and capital. Entrepreneurial energy is funneled into a narrow set of scalable opportunities. The system filters not just companies but human ambition itself. Startup language, burn rates, pivots, runways, hides the human cost. A burn rate is the speed at which a team's dream runs out of time. A pivot is an admission that the original vision has failed. The end of the runway means unemployment and the collapse of shared purpose. Founders carry the weight of their teams and investors, forced to project confidence while consumed by doubt. The culture discourages vulnerability, leading to isolation and silent suffering. When the company fails, founders are left with nothing: worthless equity, personal debt, and damaged self-worth. The system, which set them on an impossible course, remains blameless. It moves on, searching for the next dreamer. This cycle of hope and disillusionment is the hidden fuel of the innovation economy. The system depends on a steady supply of ambitious people who believe they'll be the exception. The human cost, burnout, mental health struggles, lost years, is invisible on any balance sheet. The cost of one diamond is the dust of 1,000 crushed stones. The system is evolving: more money, bigger funds, greater pressure for massive outcomes. The search for the next trillion-dollar company is on, amplifying all the dynamics we've seen. The machine is more powerful and demanding. The current is stronger. As technology advances, especially AI, winner-take-all markets will multiply. We'll see incredible innovations and rising human and societal costs. The system will keep filtering ambition into a narrow band of hyper-scalable opportunities. Yet small signs of change are emerging. New funding models, investors focused on sustainability, founders rejecting grow at all costs. These are small sprouts in the concrete, offering quiet resistance. But the main current remains powerful, and the allure of changing the world is hard to resist. The machine will keep producing wonders and consuming dreams. The high failure rate isn't a problem to solve, it's the intended result. The system is working perfectly, just not for most people. So we're left with a question: when a system shapes our ambitions so completely, are our dreams truly our own?